There are over $100 billion of them outstanding. More crypto is traded against them than any fiat currency. They've grown by over 5 times in market cap over the past year, and they could be one of the biggest black swan risks to the crypto market on record. I am, of course, talking about stablecoins. Stablecoins that have become pivotal to the global liquidity in the crypto markets. In my video today, I'm going to be talking you through this large sector of the crypto market. I'll be letting you know exactly how they operate and whether they really do impact the price of Bitcoin. Finally, I'll be exploring the potential risks that lie beneath the surface of these stablecoins. You don't want to miss a thing. Good afternoon, I am your crypto doctor. Now, while I may be able to advise you on your crypto-related aches and pains, I am not able to prescribe any financial treatments. That's because I am not a financial advisor. I don't have that diploma on my wall. Now, if this is your first time at our clinic, allow me to introduce myself. I am Dr. Guy, and I will be treating you today. The Coin Bureau Clinic performs surgery on dying portfolios with life-saving crypto education. So, if you'd like to be cured of your shitcoin ailments, please take a seat in the YouTube waiting room by tapping that subscribe button and pinging that bell. You don't want to miss this vital info. One more thing, this treatment may not be for everyone, so feel free to skip to a section below using these wonderful timestamps. Although, as your physician, I encourage you to complete the course of treatment and watch the whole way through. All right, your crypto doctor will see you now. To kick things off, I want to give you a quick overview of stablecoins in general. As is probably quite obvious, these are cryptocurrencies that are pegged one for one to the value of another asset. In most cases, this is a fiat currency like the US dollar. While there are stablecoins that are tied to other currencies, they are relatively insignificant in the grand scheme of the stablecoin market. So I'll be talking about USD stablecoins exclusively in this video. Stablecoins are able to maintain their peg thanks to 2 separate mechanisms. The first is decentralized stablecoins that rely on collateralized debt and smart contracts to maintain their peg. The second are centralized and fiat-backed stablecoins that hold a certain amount of cash in a bank in order to make sure the currency is backed one for one. The centralized fiat-backed variants are the most common and popular. These are the ones that command the most liquidity in the markets. Despite how revolutionary decentralized stablecoins like DAI are, they still do have their problems. People still feel a lot more comfortable knowing that the stablecoin they hold is physically backed by some cash somewhere. When it comes to these centralized stablecoins, you have quite a range out there. The most popular are Circle's US coin, USDC, Gemini's GUSD, Paxos Standard's PAX, and the granddaddy of them all, USDT. Yep. Despite the explosion in issuance of other stablecoins, Tether still remains the most popular and most controversial stablecoin out there, something I'll touch on in a bit. Now, these stablecoins provide a fundamental function in the cryptocurrency markets. Not only are they used in order to secure the dollar value of gains, but they also provide immense liquidity to the crypto markets. In fact, if you were to hop on over to CoinMarketCap or any other of the coin tracking sites, you will see that stablecoins are the most popular trading pairs against other cryptocurrencies. In other words, people are trading crypto against stablecoins more than they are doing with traditional fiat. Increased liquidity is essential for the smooth operation of the crypto markets. Not only does it mean that it will be easier to execute larger block orders, but it also aids in the process of price discovery, vital for the efficient function of global markets. Apart from this, there's more adoption of stablecoins to be used as a method to pay for goods and services. Merchant adoption is on the rise, and by accepting payments in stablecoins, these merchants can reduce the risk from price volatility. On top of all this, stablecoins have become incredibly popular in DeFi protocols. They are borrowed or lent out to those users that would then use them to earn interest, etc. The point of the matter is, stablecoins are incredibly valuable to the crypto ecosystem. And it's for this reason that their restriction or their limitations could pose such a risk to the market. There are a number of risks that are posed with stablecoins. Perhaps the most important of these is what is more generally termed a run on the bank. Quite simply, it's a situation where all of those who have the stablecoin in question will rush to withdraw all at the same time. This could be as a result of some sort of lack of confidence in the stablecoin in question. Now, you may be asking, why is this a risk if they have certain USD backing up their stablecoin? Well, that's because there have always been concerns that some of these stablecoins are not fully backed by cash. They're sometimes backed by other assets labeled as equivalents. Here you have a breakdown of Tether's reserves, for example. As you can see, over 75% of the assets are these shorter-term equivalents. Commercial paper makes up 65% of this. Now, how easy is it to sell commercial paper in a mass liquidation event? Can they do it in enough time without impacting on the potential redemption value? It's hard to tell. The above reserves are pretty representative of the rest of the stablecoins on the market. I should also point out that these are attestations and not full audits. Yeah, there is a difference. So what we have is a situation where you have a system that has not been fully stressed under contagion circumstances. All you need is some sort of a spark that could precipitate a run on stablecoin redemptions. There are a lot of potential sparks out there that could drive this contagion. And I have a feeling that a spark is not likely to come from the stablecoin issuers themselves, but from the regulators, politicians, and central bankers. Yeah, there's no question that the regulators are taking an increasingly more skeptical tone towards stablecoins. Where do we start? Well, last year you had some of those progressive Democrat politicians. They proposed what was called the Stable Act. This was mostly seen as an attempt to circumvent Facebook's DM stablecoin, although the wording took a swipe at all stablecoins. Basically, the proposed act would request stablecoin issuers to obtain a banking license as well. This has fallen by the wayside, but you can see that even progressive politicians are not too happy with it. Just ask Elizabeth Warren, who more recently labeled stablecoins as wildcat notes that were issued by poorly capitalized banks in the 19th century. She also had some pretty choice words for Bitcoin and other cryptocurrencies, but that's a topic for another video. Over at the Fed, they're also taking issue with some of these stablecoins. According to Eric Rosengren of the Boston Fed, stablecoins like Tether could be, quote, new disruptors to short-term credit markets. Let's hop across that pond and see what they're saying over on the old continent. The chairwoman of the ECB said that stablecoins pose a significant risk to financial security if they're widely adopted. She had many of the same criticisms that are leveled at other cryptocurrencies, including the fact that they do not fulfill the functions of money. Hopping across the channel, you had the head of the Bank of England also throwing shade at stablecoins, saying that payments with these needed to meet the same rules as banks. However, one of the biggest regulatory risks for me is that coming from perhaps one of the biggest tether markets out there, and that would be China. Ever since China cracked down on yuan Bitcoin trading back in 2017, a massive market has opened up for USDT Bitcoin trading. You can actually see just how closely the two are related here in this chart from the folks over at Masari. CNY trading fell to almost zero as it was replaced by USDT. USDT trading went from almost nothing in 2017 to over 70 to 80% at current levels. You also have further evidence that comes from those blockchain sleuths over at Chainalysis. They say that stablecoin trading in Asia is, quote, off the charts, and it makes up a full 33% of all the value that has been transacted on-chain. The reason for this is because Tether has been one of the primary sources that Chinese OTC dealers have used to be able to operate their businesses, even despite those fiat on-off-ramp options. Over the past 4 years, the Chinese regulators have let it slide as the market mushroomed. However, as we've seen more recently, they've begun a hard crackdown on crypto in the country. This was mainly in an attempt to foist their centralized EU and CBDC on their people. That, again, is a topic for another video. Oh wait, that's right, I've already done one on that. The point is that China now has a strong incentive to crack down on the trading of all cryptocurrency. This includes stablecoins such as Tether. It's actually a point that was raised by Philip Gillespie, a crypto liquidity provider based in Japan. He stated that the issuance of this digital yuan could be the biggest risk to the markets. He also claimed that any clampdown on stablecoin assets could lead to a massive liquidity shock with massive panic selling ensuing. It's a concern that's also shared by the folks over at JP Morgan. In a February report on the crypto market, they stated that, quote, if any issues arise that could affect the willingness or ability of both domestic and foreign investors to use USDT, the most likely result would be a severe liquidity shock to the broader cryptocurrency market. This is perhaps the concern that many have with an asset that helps facilitate most of the crypto liquidity around the world. Mass amounts of USDT being dumped on the market could hammer its price and drive it off the peg. This factor itself would cause a loss of confidence in the currency as a store of dollar value, which would further precipitate its sale. Like traditional bank runs, panic feeds on itself. Okay, so those are the fears that exist out there for stablecoins. However, are they justified? Firstly, let's start with those questions around the reserves of Tether. This is perhaps one of the biggest questions that looms over the crypto markets. Now, I should point out that Tether has been under some of the most intense scrutiny over the past 2 years. This is because it's been under investigation by the New York Attorney General. This was all in relation to potential losses around Crypto Capital Corp. I don't have the time to go into the case today, but feel free to watch my Tether vid for me. Top right, por favor. Anyways, after more than 2 years investigating Tether, the NYAG decided to settle with them. For many, this brought to an end all of the concerns that there seemed to be around legal action being taken. By accepting this settlement, US authorities were effectively acknowledging that. Then, in March of this year, you had that official attestation of the reserves of Tether that was issued by More Cayman. These are the local subsidiaries of More Global, a top 20 auditing firm. This attestation showed that Tether's stablecoins were effectively fully backed. There were enough assets in the bank to cover any redemptions. Some people may have taken issue with this, as they said that it was not a full audit. But then again, none of the other stablecoin issuers had done this either. That includes USDC or Gemini. Attestations of their reserves is what they'd all done. Now, this is just speculation on my part, but I assume that these large auditing firms do not have the experience in auditing stablecoin issuers. Then, when it comes to those potential risks from liquidity events, they are right in saying that it has never been tested. However, I can tell you what has been tested, and that is the liquidity of your traditional banks. We've seen on countless occasions about how easily bank runs can form. We saw this in the financial crisis. We saw this in Greece and Cyprus. This is because banks are inherently undercapitalized. This is all because of the fractional reserve model that our current banking system is built on. If you don't know what this is, then my video on the great fiat Ponzi should be next on your list. You know where to find it. The point of the matter is that under a fractional reserve system, banks have less in capital to support withdrawals than stablecoin issuers do. Stablecoins are fully backed, whereas banks only hold a fraction of their deposits. Banks are inherently unstable. So I think that in a run scenario, stablecoins will be a lot better suited to meet the requirements for withdrawals than most other financial institutions. They've also become a lot more reputable in the eyes of authorities. Firstly, you have to consider the fact that Coinbase has just listed USDT. This is a company that's listed on the New York Stock Exchange. Do you think they would have done it had there been any concerns around Tether? There's also been mass adoption of these stablecoins and their technology by a number of financial service and banking companies in the US. For example, Visa will support transaction settlement on USDC. Or how about this announcement over here that Signature Bank will be integrating with Circle Tech? These companies would not be doing it had they any concerns around the regulatory crackdown that could be coming. And while there may be some concerns with their liquidity at the Boston Fed, the vice chairman, second to Jerome Powell, said that we should be saying yes to stablecoins and that there is no need to fear them. Now, what about that elephant in the room? Yes, while a Chinese ban is a risk, I doubt it would have that much of an impact. This mainly comes down to one simple fact. It's a decentralized stablecoin that's issued on an open source platform. You can't ban it unless you completely shut down your internet. And even then, the moment you switch it back on again, people will start transacting. So I happen to think that this China FUD narrative is a bit overblown. It was overblown when they banned crypto in 2017 and every year since then. The same can be said for any country that is thinking about banning a cryptocurrency, and that includes stablecoins. Okay, so that's my view of the supposed existential risk that is posed by these. However, there are still concerns out there that stablecoin prints are impacting on the crypto markets. So, are these warranted? If there's one thing that's likely to get the attention of the crypto media, it's stablecoin prints. Whenever there is a large amount of Tether being printed, Twitter accounts and news articles cover it as if an inevitable pump could be coming. They take the view that these new stablecoins will be used by the whales in order to buy Bitcoin and hence push up its price. And when it comes to these printing presses, they have been in overdrive this year. In fact, the only printing press that I think has been beating Tether is that of Jerome's over at the Fed. Anywho, do these stablecoin prints have any impact on the price? Well, as a man of research, I usually like to lean on, research. There are two academic papers that have tried to study the impact of these prints on the crypto market. The first is this study by Richard Lyons and Ganesh Viswanath. It takes a look at the price impact on cryptocurrency immediately post the issuance of a large amount of stablecoins. They basically use statistical analysis in order to find the aggregate impact across numerous different issue periods. Here you have the results of their analysis. On the left, you have the impact on the Bitcoin markets, and on the right, you have the impact on the Ether market. As you can see, in the case of Bitcoin, there was actually a continued fall in the price of Bitcoin post these issuances. In the case of ETH, there was an initial fall in the price, although things did pick up after that. However, the relationship is not strong enough for the authors to conclude that there really is an impact. According to the authors, quote, "The bottom line, we find no systematic evidence that stablecoin issuance affects cryptocurrency prices." Another paper that we can take a look at is this one from the Blockchain Research Lab. It's a lot more comprehensive and uses more data as well as analyzes it across more cryptocurrency pairs. When it comes to their results, they are a bit less straightforward. The results differ according to the stablecoin in question. For example, in the 24 hours just before a Tether stablecoin print, you see positive abnormal returns. This seems counterintuitive, as crypto cannot be bought with USDT unless it's been issued. Some of the other smaller stablecoins on the list, like Huobi's HUSD and Binance's BUSD, see positive price reaction after the event. Something else that's also quite counterintuitive is the fact that the size of the returns is not impacted by the amount of stablecoin that's actually printed. So, based on this information, the authors conclude that these periods are as a result of arbitrage between the various stablecoins and broader market price discovery. Of course, some of you may have observed the increase in prices post a Tether print and used that as information to inform your assertion. However, it's also likely that people buying in expectation of higher prices from a Tether print are the ones that are pushing the price up. News of Tether print impacts prices more than USDT actually buying crypto. In fact, if I was a nefarious crypto whale who was part of the Tether Illuminati, I would actually use Tether prints as a method to play the market in order to make them think that I was about to buy. Conspiracy? Well, possibly. But then you may not have seen my video on the Wyckoff method. That's in the usual spot. Well, that's it for most of this vid, though I have a few final thoughts for you folks. Stablecoins have become a $100 billion ecosystem for a reason. They are able to provide liquidity in a fiat alternative that is actually better than fiat. All the qualities of the US dollar without its limitations. They've also become immensely popular for their use in DeFi protocols. They're also transforming traditional finance as they're being used by payment networks and banks. Of course, this popularity does come with its fair share of skeptics. Many politicians and authorities view their rise as a risk to the US dollar. They claim to be uncomfortable with their reserves and whether these could stand up to a mass redemption event. However, as I've shown, stablecoins could provide more liquidity than actual banks and financial institutions in a crisis. They have full attestations of the reserves that they hold on their books. Yes, it's not a full audit, but the last time I checked, the Fed has never undergone a full audit either. Are there risks with stablecoins? Of course there are. There's no knowing what a government might arbitrarily decide overnight. China seems to be pretty consistent in its erratic stance towards cryptocurrency. If it does take aim at Tether, it could create a confidence crisis in it. However, I don't think that's likely. As we've seen on multiple occasions, you cannot ban a cryptocurrency, and it amazes me that people still try to do this. And as I've shown, the broader assertion that stablecoin prints impact the markets does not appear to be borne out by the data. There are weak statistical relationships that actually make less sense than the hypothesis. So, unlike most, I do not fear stablecoins. In fact, I'm quite positive about their impact on the market. And this is particularly the case when it comes to the networks that these stablecoins are issued on. There are quite a few of them, but the predominant one at the moment is, of course, Ethereum. And as you guys will no doubt know, I'm bullish on ETH and I hold it in the largest proportion in my portfolio. You can therefore bet your bottom gwei that I will be keeping a keen eye on the progress of the stablecoin markets. Well, I hope you enjoyed that video. Let me know what you think though. Are you guys concerned about stablecoins? Do you think that the Tether conspiracy has been put to bed? Use those comments. And while you're tapping away below there, you absolutely have to know about my socials page. This is a web page that has the links to all the other official places to follow me. These include Telegram Insider Channel with daily market updates, Twitter for announcements and the occasional story, Instagram and TikTok for behind-the-scenes fun and memes, and the creme de la creme, the meat and potatoes, the cherry on top, you get the picture, my weekly newsletter. It's here that I share my crypto tips as well as a breakdown of my personal portfolio. So be sure to head down below and hit that top link in the description. So, if you guys liked this guy's vid, share the love. Hit that like and tap that subscribe. Ping the bell as well for good measure. You don't want to miss what else I have coming. Till next time, ta-ta.